Hello, all. Lovely evening to one and all present here. Hope you had a sumptuous lunch. It is no news that the Indian market has given fantastic returns in the last 9 months. The Nifty 50 delivered nearly 20% returns, and the Nifty Small Cap 100 surged 54% in 1 year. Now, don't we all have the willingness, the desire to be a part of this bull run? Indeed, we do. So, without further ado, I will pass on the podium to Mr. Rajat Setiya and Mr. Rohit Balakrishnan, co-fund managers at ithought. Hope you have a fruitful session.
Hey, thanks, Tarun. Uh, Good evening, everyone. Thank you so much for joining us today on a Saturday evening. Just one quick check. Tarun, am I audible?
Yes, sir. Clear.
Okay, perfect. And the presentation is visible, right?
Yes, sir. It's visible.
Okay, perfect. Thanks. So thank you so much, everyone, for joining us today on a Saturday evening. Really appreciate it. So, topic for today's webinar is how do we really, invest during the times like today, and times like today are indefinitely followed by uh, you know um, little not so good times. So bull market is always followed by bear market. So how do we really prepare ourselves during such times for the inevitable that is to come? So let's dive in. So this is the broad uh, context for the today's presentation. Let's begin. So let's first look at how the current market context is. We all know that we are in the middle of a bull run. So still, let's look at some of the data points which are also pointing towards the same. As we all know, liquidity is very strong in the market. Sentiment is very positive, especially after the recent election wins out by BJP in the key states. At the same time, earnings for BSE 500 in this year is very strong, as you can see in the 9 months ending December 2023. PAT for BSE 500 company has actually grown by 33%, which is very strong. So some of the broader macro data points which are pointing towards that where are we in the market right now. So as you can see, SIP flows, monthly flows are continuing to go up year after year, and today they stand at one of the highest ever that Indian markets have seen. Then FPI, FII, this is foreign money coming into India. This particular chart is basically a summation of debt and equity put together, and we are looking at the highest ever flows. We are almost touching distance from the highest ever flows. Very interesting slide. India's share in the emerging market index has actually doubled. That essentially means that a lot of foreign money will come to India even at a faster pace now because our share in the index has gone up globally. So another reason why flows in Indian markets are strong. All of us know that these days a lot of IPOs are coming up and they are doing pretty well. In fact, last year was one of the fourth best year in the last 10 years. Well, this is a very interesting slide. It basically is showing what is the amount of money that few companies are looking to raise through the IPO and how much bids they are getting for it. The first one in this chart is showing that a company wanted to raise 6 crores, less than 6 crores, and they ended up getting 4,000 plus crores of bids. So this basically shows the kind of craziness we are in right now. This is the SME IPO index. In the last 5 years, the index itself has gone up by 30 times. This is the SME IPO index. Finally, looking at the valuations across large companies, mid-cap companies, or small-cap companies, as the chart says, that valuations all across have gone up. All type of market cap companies are seeing their valuations going up. So clearly, all these data points are pointing towards the fact that we are actually in the middle of a bull run. With this, let's look at the earnings of the index. So Nifty 50, which is the major benchmark of our country, how it has done in the last 10 years in terms of its index performing, and how the earnings have done side by side. So if we look at the whole of last 10 years, earnings have grown lesser than the index at a lower pace. However, if we break this 10-year time period into three different phases, the first one, 2013 to 2017, and then the second one, 2017 to 2020, we see that earnings were not able to catch up to the index performance. They were lagging at a very, the big margin. However, in the last 3 years, from 2020 to 2023, earnings have grown faster than the index, which essentially means the last 3 years, the earnings are now finally catching up. And the first 7 years of the last decade basically was the time when our earnings were growing at a lower pace than the index. Only in the last 3 years they are catching up. And in fact, FY24 also, the calendar year 24 also looks promising, and this earning trend looks to be continuing. So all in all, what we have seen is that we are definitely, the data points are indicating that markets are expensive. We are probably in the middle of a bull run. So what we want to do now is that since we invest in small cap space, we want to look at last 20 years of data of Nifty Small Cap Index and see if there are any learnings for us from there. To begin with, we wanted to see overall in the last 20 years how the small cap index has done for us. So this index was started in 2004, and somebody who had invested 1 crore in 2004, January 2004, and it's been 20 years now, that 1 crore would have become 16 plus crores today. And markets have grown by almost 15% on an annual basis. So while for a long-term investor, this data point is very good and returns have been fantastic, but this journey is anything but smooth. As you can see from the chart here, that there are a lot of ups and downs. So let's look at some of the things in greater detail here from this chart. So first of all, we wanted to look at, given we are in a market which is expensive, and probably we can call it that we are in the middle of a bull run, we want to look at how this index has done from different peaks. If we look at the index data from one peak to the other, how the performance has been. As you can see, barring for one major time period, one big time period here, this one, barring for that, almost at every other time, even investing from one peak to the other has returned a decent outcome. Then we wanted to look at how returns have been for the index if one were to look at from bottom to peak. From bottom to peak, returns have been pretty good. This is the nature of the small cap index, that volatility is very high. So a couple of points here. One is that these two charts, whatever we are seeing, the data that we have calculated, one basic thing that is inherent in this analysis is that all of the money is getting invested at a particular point in time. Well, that will never be the case in reality, or most of the time at least. And with us, that will never be the case. That's not how we invest. And secondly, this is basically a data point which is used with the help of hindsight. We have calculated these data points wherein we are able to call out the market peaks and the market bottoms. In reality, once again, it is very difficult to time it. While we can look at certain data points and try to assess where do we really stand in terms of whether we are in a market which is expensive or whether we are in a market which is cheap, but it's difficult to call out that whether we are at the peak or at the bottom of the market. So in terms of real life implications may not be much, but what these two slides are basically telling us, market is volatile, and even investing at the peak of the markets, you can do okay. Third point here is that this is the data for index. If you look at this time period here, it says that investing from one peak to the other, It took almost 8 years and no returns. However, if we double click and look at some of the companies during this time phase, that was the golden period for small cap index. A lot of new sectors were discovered by the market. A lot of new companies, which were very small, tiny market cap or micro market cap, they went on to become bigger in their sizes, touching 10,000, 15,000, 20,000 crores. Now let's look at another slide, which is again dissecting the same chart in a different way. So what kind of drawdowns have happened in small cap index? Again, this is index data. Individual stocks data can be very different and can be even more negative. As you can see here that we have seen big drawdowns. So one thing which is coming out very clearly from this chart is that the drawdowns are inherent feature of the market. Every up cycle is followed by a down cycle, and therein lies the opportunity as well. So one very important learning that we have, or the message that we have from this slide, is that markets will fall at some point in time. They always do. This chart, as we can see, is showing corrections in different phases, ranging from 30% to almost 77%. That's almost like getting wiping out from the market. We have not even shown 15 to 20% kind of corrections here. Otherwise, this chart will look like all blood red. But this is the one major learning from this chart, that market will see correction. They always do. So we need to prepare accordingly. We need to prepare ourselves so that we can withstand those corrections. Because in the first slide, we also saw that if we are invested in the markets for a long term, you can get benefit out of it. You can make a lot of money. But that long run is not smooth. It is always marked by these volatile moments of going up and down. So how do we really prepare ourselves for that? Second, learning that or the message that we can take from this slide is that how do we really take advantage of it? Not just that we need to be invested in the markets for long term and then prepare ourselves for these kind of corrections, but whenever these corrections happen, how do we take advantage of it instead of getting bogged down by these corrections? How do we become more aggressive and take advantage during such time, and push our returns during such time? So let's look at some of these things. The first point we would like to say here is that we need to be very careful while we are building the portfolio. We need to buy or build a portfolio which can withstand such market corrections. What does that mean? It means that whenever markets are in a down phase, your portfolio, well, you can't dodge the direction of the market. If market is falling, portfolio is also bound to fall, because during market falls, everything falls, be it good or be it bad. And therein lies the opportunity as well. So how do you ensure that the portfolio can withstand market correction? And second point is how do you ensure that you are able to build such portfolios, that you should not rush into deploying money immediately, especially during such times. One should be very careful in terms of deploying the capital. There will come a time when deploying the capital will make more sense, and there will come a time where there are times when deploying capital immediately just doesn't make any sense. So one should be very, very careful and very patient in terms of deployment of the capital. And the real key or the output that you would want to see whenever market corrections happen is that the portfolio doesn't fall as much as the markets. And if we can achieve that kind of an outcome, whenever we see the full cycle, the markets go down, then markets come up. Whenever we see the full cycle completing, the benefit of not losing money as much as the markets really helps in terms of generating the outperformance whenever the cycle completes, whenever the markets go up. Every penny saved during such times actually results in alpha creation. While your portfolio is negative, but whatever amount that we are able to save from falling in line with the market is actually becoming the bedrock for the future performance. And touchwood, we at VRDDHI have been able to outperform in every such market corrections. And we'll talk about how we achieve that outcome. and we need to avoid certain common mistakes that happen in a bull market. And and by doing all these things, probably we are then ready to uh, prepare. We can prepare the portfolios which can withstand such corrections. So, what are those common mistakes that happen in a bull market? One very common mistake is that there are stocks and stories which become very famous and everybody wants to buy. For example, in 2000, there was internet story. In 2007, everybody wanted to invest in infra. So we need to understand that trees do not grow to the sky. While a company or a sector may continue doing well, its valuations, which are accorded to by the market, they become very expensive, and we should be very wary of the expensive valuations when we are buying a stock. This is really, really important. And in times like today, maybe electric vehicles or electronic manufacturing services, maybe these are some of the sectors where you can see a lot of frenzy and valuations touching almost the sky. So you need to avoid every such sector and avoid doing certain mistakes. So we have seen how markets are probably expensive and what kind of returns index has given over the last 20 years, and from point to point, be it at the peak or be it at the bottom, and what kind of corrections that have happened in the market. So we wanted to look at how Vriddhi as a fund has done, how different portfolios in Vriddhi, which were started at different point in time. Some portfolios were started at the peak of the market. Now, with the benefit of hindsight, we can clearly see that those portfolios were started at the peak of the market. Some were started during very normal phases of the market, and some were started during the correction phase of the market. We wanted to see how different portfolios which started at different point in time have done for us. So here we have highlighted the first two rows. If you see, those two rows are the rows which actually were started at the peak of the market. While you can see that portfolio performance of every vintage is decent, and we have been able to beat the index very handsomely. At the same time, these first two rows we really wanted to talk about is that these two vintages basically are the time periods when markets corrected big time. In the first one, markets corrected by almost 65% over the next two years or so, and in the second one, markets corrected by 30% plus, and that correction also lasted for almost 5-6 months. So despite starting at the peak of the markets, how were we really able to achieve such outcomes? Let's look at that. And the third row here that we have highlighted, we'll also talk a lot about it in today's webinar. So how did we really achieve such outcomes that we started at a time which turned out to be the peak of the market? The first one is that we like to invest in companies which are market leaders. This is very important point. Companies which are market leaders, they tend to benefit from crisis situations. Whenever markets fall, whenever there is any dislocation in the market and the industry that they operate in, or whenever there is any economic slowdown in the country, such businesses tend to benefit because they are market leaders. They can sustain, they can survive, and a weak company cannot survive. And the market share that the weak company leaves is that automatically comes to the market leader. So it is very important, first point. Second is that you should not invest in a debt heavy company. Rather, we like to invest in companies which are cash rich. Now, a cash rich company cannot go bankrupt. Whenever there are any liquidity constraint in the economy or there is tight liquidity, and whenever the sector is struggling, like transformer sector in the last 10 years, or the real estate sector in the last 10 years, or the infrastructure sector in the last 10 years, only the companies which had strong balance sheet have survived, and a lot of the companies have gone bankrupt in these three sectors, for example. So we like to invest in companies which are strong in terms of balance sheet, rather they have a lot of cash on the books, and companies which are under research. This is some kind of advantage, competitive advantage that we can gain. Companies which are small in size, as you can see in the third column, the market capitalization of companies that we bought at the time of our entry, almost all these companies were below 500 crore in market cap. And you can see the current market cap of these companies. So The companies that we like to invest are the companies where market is either ignoring those companies, or market doesn't know about them much. So there are not many institutional investors invested in that company, or it's a very small company, but market leader, and there's not much coverage on these companies. So what you can do, how you can really take advantage of such situation, is that you can go out, you can do your research, you can connect with, it involves a bit of hard work, but you can actually gain some advantage out of it by, let's say, you speak to the bankers, you speak to the auditors, employees, ex-employees, or the customers of the company, or the suppliers of the company. You try to understand as much as you can about the company and then invest. And the other aspects that we like to see is that these companies are run by good promoters, which have very good execution track record over the last 10-15 years. And finally, that these companies are available at good valuations. Then we like to focus a lot on risk control, and no, we don't focus on returns maximization. We believe that is not the way one should approach the markets. So yes, risk control, or looking at what can go wrong in your portfolio, is really important, and that's what we like to focus on. In fact, this was the very first lesson that we learned in our investing, that we should focus a lot on what can go wrong, and we should try to protect our downside. If we are able to protect our downside, upside takes care of itself. This was the very first lesson that we actually learned in our investing almost 13, 14 years back. And it has stayed with us, and it has really done wonders for us. And we'll share how it really helps us. So we should try to stay clear of what can really kill us. So in the last slide, we looked at what we like to do. In this slide, we will see what we shouldn't do. So these are some of the things that can actually, uh, go against our wealth creation journey, and they can kill us in the time frame that we are operating. And we should definitely try to do these things. These are not good for our financial health. So these are some of the things that we really avoid. Now let's look at, we have talked about what we like to do, what we do not like to do. Now let's even despite that, there are, ultimately we are all human, and human biases come into picture. So mistakes can still happen. But if you design a process before you take a decision, there you can minimize the number of mistakes that you do. So how do you really do that? What is the process that we have designed for ourselves? Well, this process has been working for us, and over time we have strengthened it. And today we can definitely call it a multi-layer filtering process, wherein one person presents the idea, and the second person's job is only to shoot down that idea. Well, it may sound little weird, but one person on the table is talking about why we should invest in a company, and the second person is only talking about why we should not invest in the company. So both need to convince each other. While this process, this whole decision making way of taking the decisions actually uh, might sound a little funny, but it actually brings a lot of new points on the table, which the first person may have ignored because of certain biases that person may be operating with. At the end of the day, emotions come into picture, your psyche comes into picture, and you may end up getting influenced by certain factors that you may not even be aware of. And that's the job of the second person. So playing devil's advocate becomes really important. And then these two people put together whatever they agree on, then the second level of filtering happens, and ultimately, as a team, you take the decision. So the chances of reducing the mistakes, if you follow what you want to do and what you do not want to do, and you stick to that, you are already reducing your chances of committing some mistakes. But when you pass that kind of decision making through a process, through a multi-layer filtering, the chances of committing the mistakes go down a lot further. And what you are then left with is that, the risk that you have in the portfolio automatically comes down. Now let's look at the other aspect. This is one qualitative aspect that we want to talk about, and this is patience. No matter what you do, and believe us, this is the most underrated skill in our profession. People talk about this is the kind of company you should invest in, and whatnot. But having patience is equally important and very critical, especially if you are looking to grow your wealth over a very long period of time. And that's where patience really comes into picture. So what we looked at was that in the last 10 years, there have been almost 2,500 trading days. Almost 22% of the times, Nifty Small Cap Index was trading at either 30% or more of a correction phase from its peak. And almost 35% of the time, the same index was trading either 20% or more from its peak. So as the data suggests that in market, these corrections, and we have seen it in one of the previous charts, but this is more of the same in a different way. These corrections are given. Opportunities come in plenty. However, we need to see how we can take advantage of it. We can take advantage of such opportunities by being patient. So markets is gonna give you opportunities. You should do your work. You should build your pipeline of companies or the ideas that you want to invest in, all the good companies that you really like, and the companies and the good managers, but their valuations may not be in your favor. So what you do, you just wait. Market is gonna give us opportunities. It's like almost one in every 3 days, the index was trading all 20% down from its peak. One in every 3 days. So just imagine the kind of opportunities that are there in the market. Times like today may not be the such time, but times over a long period of time, 5-10 years or 2-3 years even, you will see that markets is correcting every now and then. So this is one key aspect that how patience really helps is you build the ideas, you build the pipeline of companies that you want to invest in, and then you wait for the right time. And secondly, sometimes you have invested in a company, valuations were attractive, and yet market is not rewarding it. Then also you need to fall back upon this virtue that you need to be really patient. In fact, the best performing company of Vriddhi portfolio, we held on to that company for it's been almost 5-6 years that we are owning that company. But in the first 2 years of our investing in that company, the company continued to do well. Its earning growth was happening. Its sales were growing up. It was able to sell its products to more customers, more geographies. Everything was clicking. It had debt-free balance sheet. It is the market leader. Management had fantastic track record of execution, and yet stock was down by more than 50% from our buy price. So what do you do in such cases? You need to be really patient, and that is very important. This is, like we just said, this is the most underappreciated virtue in investing, and we need to really harness it. And we day by day we are practicing it, and we are trying to become better at it. So how do you really hold on to your patience, or you practice it? By sticking to the process. So the process is simple. We have talked about it. You figure out the kind of companies you want to invest in. You figure out what you do not want to do, and eventually you become confident about the companies that you are interested about. And finally, this combination will give you the ability to be patient. So moving on, what is the other aspect that really helps us is that this slide will talk about how we treat cash in our overall scheme of things, in our portfolio management, in our decision making. So we see cash as a very important factor, something which can be used as a dry powder whenever we need money to invest in the markets. We have seen corrections are inevitable features of the market. So to take advantage of that, we need to have cash. Otherwise, how would you do that? And in the recent correction that happened, and we need to be positioned right. So what does that mean? We need to be positioned right means that you should be there to take advantage of the market. You should you should you should have some cash in the portfolio. You should be able to put some cash in the portfolio whenever markets give you the opportunity to deploy. So in the very recent correction, it was just a 2 days of correction actually. Markets small cap index corrected by some 5-6%, and some of the stocks corrected by 10-15% in those 2 days. And we were able to buy certain ideas which we were waiting for more than 6 months. So like we talked about certain things here, you can see we are how we actually walked the talk, that there were certain companies that we wanted to invest, but the price or the valuations were out of bound. So we were just waiting, and there came a big correction on a particular day, followed by another day. On those 2 days, because we were ready, because there was cash available in the portfolio, we just placed our orders and they got executed. Something which didn't happen for 6 months suddenly happened on those 2 days and has never happened again. Those prices have not come back. So so you need to be ready to take advantage of these correction situations in the market. The right side on this chart, we can see we did some quick analysis on our portfolio and the company that we are tracking. If certain number of correction happens the way we have written here, and this is the kind of deployment that we can do basis those corrections in the specific stocks that we are tracking. So finally, the last aspect of how what's the overall the way of operating at Vriddhi is how we deploy our capital. So capital deployment is very crucial part of a portfolio management, and how we do it is that the capital deployment in our portfolios that come at different point in time takes care of the current market situation. So we'll look at it. So very quickly, we'll first show you how three different live accounts which came in at a different point in time, how the capital deployment happened for them. This is the first example we are taking. One account that opened in May 2021. It took us almost a year to deploy the capital. Second example, this account opened in May 2022, and within 5 months, we were able to deploy all the capital. This is the current situation. One account which opened in the month of January, and in 2 months we are close to just 35% of capital deployment. We are not able to deploy capital because valuations are really very expensive right now. So we have our long pipeline of ideas ready, but we cannot deploy capital right now because these are expensive companies. Valuations is expensive at the moment. We are waiting for the right valuations. Any correction, like we showed in the previous slide, that any small correction that happens in the market, how much capital we can deploy, we are ready with our stocks and the cash in the portfolios. But there is one key message here on this slide, is that we do not like to deploy capital in one shot. We do not follow model portfolio that you give us money and we deploy it irrespective of the valuations of the stocks that we want to invest in. We did one analysis on the multibaggers of the last decade in our country as a whole, in the whole of listed universe space. And what we saw in the data, that 1/3 of the returns are actually coming from valuations. You need to buy at a valuation which can be considered fair or reasonable or cheap, and then that valuation grows and then the stock becomes expensive. So buying companies at the right valuation is contributing 35% to our returns. So it is a very crucial aspect, and being a fiduciary of your money, this is our primost job, that we take your money very seriously and we deploy the capital not on an autopilot approach, not on a model portfolio approach, rather case by case basis, wherein we invest in companies which are also offering us good valuations. And that is the reason right now we are not deploying a lot of money. And this calibrated approach towards capital deployment has worked wonderfully for us in the last few years. And And that is probably a reason why you see some of the portfolios which were started at the peak of the market have done really well for us, despite being starting at the peak of the market. However, this approach doesn't come without its shortcomings. And those shortcomings are only for the short term, because you are not investing capital and markets are going up. Naturally, your portfolio is not going as much as the markets, and there will be underperformance in the short term. However, we are not here for short term. Like we said, we are here for long term. We want to be in this journey for 4, 5, or even more years, and during that long frame of time, we have seen time and again corrections happen, and this cash which is lying with us will prove very, very crucial. Now let's look at, so far we have talked about the kind of investing we like to do, and we are telling you this is our formula or this is what we do. Now let's see how this philosophy is playing out in action for us in our portfolio, whether we are really walking the talk or not. So starting with, we did one analysis on all our multi-baggers companies which have gone on to become at least 2x for us. We saw some of the metrics at the time of our investment and after our investment. As you can see, most of the companies were very comfortable on the debt side. Rather, no company actually had debt equity of 1 times, and their debt position improved drastically. There were 11 companies which were cash rich at the time of investment, but after investment, those number of companies which became cash rich increased, and they became 15. And every other company saw improvement in their debt position. Similarly, when it comes to earning growth and the return on capital, which basically depicts the quality of the business, you can see that in the 5 year prior to our investment, the earning growth was around 15%, and same was the return on capital, which is considered a very decent number. And after our investment, both the metrics shot up like anything. And this is the entry valuation slide, wherein we are showing that uh, companies where we invested, which have become good for us, which have done really well for us. We invested in some of these companies at very attractive valuations, either at 1 time book value or at 15 times their cash flows or earnings. And this is, like we said, this particular aspect contributes 35% to the returns of the multi-baggers in the last decade that India has seen. Then, like we said, we like to see or invest in companies which are market leaders and which are not really covered by the street as such. And here on this slide, you can see almost 60%. Majority of our companies are basically market leaders. They are debt free. They are not covered by any external, sell side brokerage. Very quickly, 9-month portfolio update. How our portfolio did in FY23 and how it has done so far in 9 months. In FY23, while sales growth was good, 16% median sales growth, but margins were under a lot of stress because of inflationary pressure, because of logistics costs going up and disruptions in the supply chain. However, in the 9 months in this year, all those inflationary pressures have started subsiding, and that's why you can see that median sales growth in the portfolio, while being in the similar range of 16, 17, 18%, the profit growth has been phenomenal. Median EBITDA growth in the portfolio is 35%. So this is a very quick chart on our multibaggers, and these are some of the names which have gone on to become multibaggers for us. And this is the performance of VRDDHI since inception. We have almost 10% cash at the portfolio levels, but every portfolio performance will differ because the timing of the portfolio matters, and cash in the accounts in different portfolios will be different because portfolios which are starting out now will have a lot of cash. And that is the reason why in one of the slides where we were showing our vintage returns, the last row showed that the accounts which started in the last 1 year are lagging the market because they're sitting on a lot of cash. So this slide is basically showing that if you had invested 100 rupees with VRDDHI at the beginning of the PMS, it would have now become 229, and how that same 100 rupees, if they were invested with different thesis, what's the outcome. We have been able to beat every sort of index, be it small cap index or the large cap index. So, how the Indian economy is expected to do from here onwards, we believe the scope is very good. Balance sheets of the corporate India as well as the banks are now clean. They are willing. Banks are ready to lend. Corporates are ready to borrow, and capex cycle, which we believe had just started, and the data is also pointing towards the same direction. Data that is released by RBI on the utilization of capacities of different manufacturing firms. So all these data points are pointing towards the fact that next 5 6 years can be really good, and to top it up with certain different aspects which are helping the corporate India is that lower corporate tax rate, China plus one, which is helping Indian manufacturing sector in certain key sectors, not everywhere. And we saw that India's spot in the emerging market index has gone up. The share has gone up, and India is seen now the best emerging market, which is growing at the fastest pace in the globe. So all these factors put together, we believe Indian economy should do really, really well for the next few years from here onwards, at least. So just to conclude everything that we have talked about, definitely right now we can say that markets are in a heated zone, and we don't know whether it is the peak or where we are exactly, but definitely right now we're in somewhere in the bull run, and patience will be the key to to ensure that we enter the companies at the right valuations. And we have seen time and again markets do give us opportunities, and we need to be positioned right. We need to be there to take advantage of the market. We can't take advantage of the market sitting from outside. We need to be there. Like we have seen, just sometimes these corrections happen for a couple of days, and to do that we need to have some cash in the portfolio. And from our side, we are ready with our set of ideas. We see cash as a dry powder. We do not like to time the market. Whenever we see a company available at good valuations, we will approach that company. We will buy that company. And sticking to our process, sticking to our philosophy has done wonders for us, and we believe we'll continue doing the same. This process that we have designed and strengthened over the years is the key, we believe, to our success here. And we do not like to focus on returns. We like to focus on risk, because ultimately markets are going to turn around. Markets are going to see a big drawdown phases as well. So focusing on risk, which you can do only during today, because when markets are falling, you can't really do anything. You are just a sitting duck at that point in time. So whether you want to be a duck or you want to be somebody who is enjoying that correction depends on what kind of decisions you take today. And that's why we focus a lot on risk control, so that we are ready for any kind of market corrections. And given markets, the way markets are running right now, and our approach of gradually deploying capital, not rushing to deploy capital, we do not follow model portfolio. We are very cognizant of entry valuations. This approach is not going to be it's probably will result in short-term underperformance if markets are going to go up from here onwards. And overall, just to sum it up, just to conclude, the last point we would make here is that when we say we need to be positioned right and we need to take advantage of the market corrections, SIP is the best way to do that. When we do SIPs, we are able to add money to our portfolios on a regular basis. And whenever there is any opportunity in the market, the portfolio can take advantage of it. And SIP is the best way to do that. With that, we come to the end of our VRDDHI presentation. And very quickly, this is our whole investment team. We believe we are doing wonderful research at ithought, and this is the whole team and the whole structure here. The ithought universe, wherein the different PMS products that we have, beginning with Solitaire, which is the flagship product of ithought. And this product basically invests in companies across all sort of market cap companies, and the focus is a lot on risk. Like we have talked about at Riddhi as well, and this is the genesis of all the products here at iThought, that we like to focus a lot on the risk aspect. So generating superior risk adjusted return is the key here, and this product has done wonders for all the portfolios that we have seen. And the second is True Blue, wherein we invest in bluest of the blue chip companies, and we have picked up amongst the top 50 companies in India and invest in them at the valuations of our preference. And these companies are, as you know, they are one of the largest companies in India. Then we have talked about Riddhi, and finally Sphere, which is a multi-asset product wherein a lot of focus is given to the macros in creating the portfolios across different asset classes. And with that, we come to the end of the presentation. Now we are ready for any questions that you might have for us. You can type in all your questions in the chat box and we'll start answering them one by one. And thank you so much for patiently listening to us. I think I've taken a lot of time. Thank you so much. Sorry, let's begin with the first question. The first question is, as PMS investor, what are you supposed to do for the next 6 months? Should I invest or should I stay away from equities, or where exactly should I invest? So our approach is we do bottoms up investing, and we have seen that markets are volatile. Anything can happen anytime. That's what is very clear from the history of the markets. So and we have seen, being in the markets for more than 10 years, we have seen that uh, companies go on to become multi-baggers even from the point which proved to be the peak of the market. And we have seen that in our portfolios as well. Yes, those companies also tend to fall when markets fall. So and then what you do is that you buy more of those companies. So it's very difficult to say what exactly, in terms of, that one should completely stay away from the markets, because we don't know when the markets are going to give us the opportunity. So we should be there in the markets, and SIP is the best way. Instead of putting all your money in one go, especially during times like today, SIP is the best way. If there are opportunities, we will deploy. Like we have said earlier, we do not do model portfolio. We do not rush to deploy the money that you will give us immediately. Only when there are ideas to be deployed, we will deploy the money. Otherwise, that money will just keep sitting there and acting as a dry powder that we have talked about, which we will use whenever the time is right. Insights of holding cash management companies. Well, we can definitely get on a call and discuss any particular company here that you are talking about. But in brief, what we would like to tell you is that cash management companies, the space overall is a space which is catching up, growing in India. It's a new space for India, because this space largely relies on organized retail, and organized retail is not new to India. It's just started probably in the last 10-15 years, and there is long way to go from here as well. So organized retail companies, basically, they have to deposit their dailies collection in the banks, and if there is somebody who can do the job for them at a very marginal cost, that company, that uh, service provider can actually add a lot of value to the company by taking the risk of taking the cash from the outlet to the bank, by saving the time of the employee who is doing the job for the retail counter. So we believe the space should grow at a decent rate, and there are very few companies in India who are operating in this space. And one of the companies that we are invested actually is the market leader here. They hold number one position in the market, and they are doing this in a very good way so far. Do you have regrets of booking profits early in PMS stocks? Well, uh, in a market like this, like the market we are seeing today, every sell decision will look like a regret. But we do not look at it from this perspective. We have a process, we have a philosophy wherein we have very clearly laid out for ourselves where at what kind of valuations we would like to buy a company and at what kind of valuations we would like to get out. If we do not see good returns getting made in a company that we own from today, uh, in the next 3 to 4 years or 5 years, there's no reason why we should hold on to that company. Markets will do their job. Market will probably take the stock even more higher or bring it down. We don't know anything about it. Our job is to take advantage of the market volatility. Our job is to take advantage of the situation that market presents to us. So when market is giving us stocks which are available cheap, we should buy. When market is giving us opportunities when stocks are expensive, we should sell. Well, those companies can become even more expensive. There is no denying in that. But we do not look at it from that perspective, and especially during such times when everything is going up. So, whatever you have sold in the last week, you will look at it like a mistake, but that is not a mistake because things tend to correct also. And at the same time, when we are selling something, we are able to deploy that money even if after a patient period of maybe couple of months or few weeks in some other idea. So that other idea we believe will also do well. So from that perspective, it is absolutely fine. Are the Vriddhi returns post charges? Yes, all the returns that we have shown here are post the charges, any piece or the profit sharing that happens, and after all the brokerage related charges as well. Can you show the slide where there was multi-bagger companies with logo in it? Sure, you can. This presentation will also be available, and you can definitely get in touch with one of our team members, and you can take a good look at it. When would adding when would adding additional money in the next months to existing portfolio make sense? Like we just discussed this point that if you have liquidity, it is better to start a SIP and whenever there are opportunities we'll take care of it. What is the minimum amount to join in Vriddhi? So be it Vriddhi or any other PMS product, our regulator SEBI has set the minimum amount as 50 lakhs. So this is the minimum amount that is being set by the regulator, with which one can open their account and begin investing with the PMS. Now we focus on large cap or mid cap or small cap. We In Vriddhi, we just focus on small cap companies, wherein a little bit of mid cap companies, couple of them, not much, and we also have some micro cap companies in the portfolio. Yeah, so this is our focus. Is this the right time to invest in Vriddhi? So honestly, we don't know. Timing is something we should not even think about, and that's why we don't know. We don't spend any time thinking whether today is the best time or today is the worst time or today is a good time, today is a bad time. The reason being, you have seen the chart. Markets can go at any point in time anywhere. Exactly 1 year back, when we would have done one webinar, we were not talking about the kind of markets we are in today. We were rather talking about how to invest in a bear market, honestly. In just 1 year, things have changed drastically. So, unless you are positioned in the market, how will you take advantage of it? Sitting from outside, it's very difficult. We then just are seeing the prices and are thinking if markets are going up, they will continue going up. Let's just not invest. When markets are falling down, we will just continue thinking markets are going down. Let's just not invest. Let it fall further. Let it fall a little bit more. Then I will invest. We need to be in the markets. Unfortunately, the short term pain that one has to go through in the market is given for the long term wealth creation journey. We cannot dodge it. Time the market has never done good to anybody. We have been here for long. We have read a lot of books by legendary investors who have been in the market for 50, 60 years. They don't do that. So we are nobody in front of them. Why should we try to even attempt it?
Rajat, I
But
just want one more.
yeah,
Can I just add? So I think I'll answer it in a slightly different way to what Rajat also. I will flip the question as to saying that it depends on your horizon. So if the horizon is probably
yeah,
6 months, 1 year, probably we don't the and probably then I think it's very difficult to say it's a good time. But over a 4 5 year period, I think uh, all these things like slow deployment or high valuations, etc., all generally tend to sort of neutralize because you are able to find opportunities and you're able to deploy. So if the horizon is long enough, then I think this is as good as a time, provided you are genuinely looking at 4 5 years. But if the horizon is short, as Rajat mentioned in the presentation, there could be some underperformance, and that given the horizon is short, that may not be a great time. That's
yeah,
it. Yeah.
absolutely, absolutely. And then maybe good time to reiterate the same thing that we saw in the presentation. Our capital deployment strategy is not that we will deploy all the money today. Our capital, you have seen somebody who started in January, we have only been able to deploy 35%, which is essentially means that 65% of the cash is lying of the portfolio is lying in the form of cash. It is only because right now things are expensive that we are not deploying. Whatever we thought is not expensive, and they are good companies, we have bought them. There are a lot of other good companies which we believe we can buy, but we are not buying because they're expensive. So whenever market corrections happen, sometimes corrections happen at a stock level and not at the whole market level, and sometimes corrections happen at the market level and then everything corrects. So if the account is already operational and there is cash lying in the account, then only you can take advantage of such situation. So this is why we believe it's a very good combination here that the account is ready and the cash is also ready. You're not rushing to deploy capital on day one and then wondering what to do when markets are correcting. Because then whole portfolio is down and there is no cash to take advantage of the market. No, that is not the situation. So somebody's asking, what is the return we can expect next year? Well, sir, this is really, really difficult to expect what can happen in the next 1 year. But what we do at our end is that we look at a 4 5 year time frame, and during that time frame, we like to double our money at the portfolio level. And some of the stocks may do well, some of the stocks may not do well. That is the kind of target that we have for ourselves, that we should be able to achieve this kind of target in a 4 to 5 year time frame. In the 1 year, immediate 1 year, 2 years, things can be very good or very bad. We don't know that, but overall, this is what we target. Will each client have a different portfolio, or will all or some of the stocks be common? So if two portfolios are starting at the same time, yes, they will have exactly the same portfolio. But if the timing of two portfolios, two accounts is different, then automatically some stocks may not be the same, because like we said, we pay a lot of attention to the valuations of the company. If the valuation of a company has gone up a lot, we will not buy that stock for the new account. And all other stocks which are still in a valuation buying range where we are comfortable, we will buy that. And whenever there is a new idea that we are buying, and if the cash is available, assuming the cash is available in both the accounts, that new idea will be bought in both the accounts. So even if two accounts are opening at a different time, barring for few stocks which may have become expensive when the second account is opening, barring for those stocks, every other stock ideally will be the same. And even the stock which had become expensive, and if the valuations corrects there and that stock also becomes attractive, that stock will also be bought. So over time, portfolios will look similar, but because of timing differences, some difference will always be there. So again, somebody wants to know, as a prediction, which sector will flourish in 2024, or in sector rotation, which sector will come in limelight. So we don't know what will happen, but we can tell you some of the spaces or the pockets of market where markets are ignoring those stocks. And usually when markets are ignoring certain sectors, certain stocks, those sectors or those stocks tend to do well in the ensuing years. Whether that happens in the immediate next year, we don't know that. Some of the sectors have seen very long downturn of 5, 6 years, like transformers or real estate or infrastructure. But now every sector, all these three sectors are doing well. Capital goods sector as a category, pharma sector goes through downturns of 1 to 3 years. IT sector goes through downturn. So whenever there is a sector going through a downturn, we believe that sector should do well over the next 4 or 5 years, and that is a good hunting ground because valuations are also attractive. Very difficult to say, sir, what will happen in the next few years, few months, or the immediate next year. Where would you invest as NRI? Example in Euro or INR? I'm not very clear on this question. But if an NR, I'm sorry, I'm not very clear about this question. So maybe you can rephrase the question and put it again in the chat box. This question is by Veera. Yeah, Rohit.
Yeah, I think if I understand the question, and please correct me, sir, if I'm wrong. As an NRI, would you invest in euro-denominated assets or INR-denominated assets? If that is what is the question, then the answer, I would say, if you understand, so first of all, investing in anything, you need to understand where you're investing. If you understand, assuming that you understand both the geographies well, I would say India would be a better bet. Ceteris paribus, assuming everything is equal, because the growth rates in India are much better and the opportunity for the rates of growth and also the period of growth, the longevity of the growth is also very high. So that would be my answer if I understood your question in the light that I mentioned.
Yeah, probably that's what the question would have. But you can specify again in the chat box. Next is, are you increasing the cash position for fully invested portfolios? So fully invested portfolios, case-to-case basis, if there are stocks that we want to buy and there is not enough cash, because this is also a time when markets have become expensive, we are selling we are selling good chunk, and in the last 9-10 months we have been able to sell good amount of shares. So we have some cash in the portfolios, and we have redeployed the cash in stocks where we are comfortable at the valuations. So on case-to-case basis, if there is an idea that we want to invest in and there is no money, we reach out to clients, and we let them know that we need money to invest in this much money we need to invest. But the best way, again, we would reiterate, is that starting with a SIP. SIPs have become very common in mutual fund side and very uncommon right now in PMS side. But it's exactly the same thing, and it does exactly the same thing here as well. The process is same and the outcome is same. So it's best to start with the SIPs so that if there are any opportunities, those can be leveraged immediately instead of waiting for the cash to come in. How do you define valuations as reasonable or expensive? So if you're talking about current set of markets, and this question pertains to current markets, or this question pertains to valuation concept in general, I'm not sure, but assuming this pertains to current markets. So we believe at the stock level, if we see there are few stocks which are still in reasonable bucket, and that's why we are finding some opportunities which are not a lot, which are few, but we are able to find some opportunities. And rest of the market, we definitely see that they are expensive. However, in the last few days, there was some correction. Some valuations have corrected. So whenever such opportunities come, we are ready to buy those stocks and deploy capital. But overall, at the market level, if we have to comment, in general, markets is no more in the reasonable zone. That's what we can say.
I think,
But yeah,
I think Rajat, you put a further comment to the question. He's asking what valuation metrics would be used, and what do you do when it becomes expensive? Maybe I can just take a stab at it and then you can add.
yeah.
So, I mean, there is no single formula as such. We look at, uh, obviously, we look at the intrinsic growth of the company and intrinsic return metrics of the company, and compare it across industries to see what similar company would earn, would be valued by the market in other industries. Sometimes you are able to find companies which are doing very well on an overall business basis on a through cycle, but because the sector is not doing well, you don't get valuations. So you compare it with, say, other companies which have similar characteristics. You look at through cycle earnings, and then you look at the company vis-a-vis the market value on a normalized earnings basis, what the company can earn, was, and compare that with the valuations. Price to book is one example, which we also use quite a lot of times if you are looking at cyclicals. And and also sometimes when you're looking at companies which are very small or young in its infancy, and the opportunity for growth is very high, then you look at what the company can earn in the next 3-4 years and see what does it do versus, I mean, what is it valued versus today, and then you take a call as well. But yeah, I mean, there is no one single way as such, and there are multiple ways to sort of see and sort of look at, and we triangulate, look at multiple different valuation ways, and usually that gives us like, we would sort of triangulate few different methods, and you come to an answer by triangulation. There is no one method as such.
Yeah.
And same
Yeah,
thing happens when it's expensive.
Yeah. Applying one method, just one metric, can actually lead to very wrong conclusions. So one should triangulate, like Rohit mentioned. Absolutely. The next question is: are the stocks bought through PMS will they lie in the client's demat account? Yes, they will lie in the client's demat account. Buying second apartment as investment versus Vriddhi investment, what is your view? Well said, depends on your horizon and your comfort with the asset class. I think you are new as an investor to us, been almost a year, I think you have been with us. We really thank you for joining every webinar you do. We really appreciate it. So I think over a period of time, you will develop comfort, and you will see what kind of returns Vriddhi has been able to do for you, and then you can take a call accordingly. Rohit, anything you have at it?
Yep. I mean, generally, I think real estate as an asset class has, over a very long period of time, I'm not saying last 3 years, 5 years, probably close to last 20, 25 years, has underperformed or lagged on equity as an asset class. Not talking about anything specific or any specific asset class like small cap or any specific mutual fund or PMS, etc. But in general, over a 20-25 year period, probably real estate has underperformed as an asset class in general, I'm saying. So if you have to ask me, I would always prefer equity. But yes, as it's not like a plain simple silver bullet answer, because equity is a roller coaster ride, as Rajat showed in his charts. You can be down 30, 40, 50, 60, 70% as well, which probably in an real estate investment may not be the case usually, whereas it's a very usual scenario in equity. So as if you are okay with that kind of a roller coaster ride, then probably you can look at equities as an asset class rather than buying a second investment in apartments. But again, it's a very individual call. I'm saying my answer, given my mental makeup and my risk preference, I would say equities. And given I invest in the same stock as Vridhi's, and so for me it would be specifically Vridhi only. But I'm biased, and my risk profile is probably different than most of the other people.
Yeah. Also, to top it up with why equities do best among all asset classes over a long period of time is equity is the productive asset class. As simple as that. A business which is doing 10 crores of profits today can reach 100 crores, can reach 1,000 crores. There is no limit, right? And you don't have to be, and you can pick those businesses. You can flip, you can, if your business is not doing well, you can change, you can move to other business. So equity as an asset class does really well because of this reason. The apartments do not give babies, they do not grow, the size remains the same. Rental income, you know what kind of rental income it is in India or the outside India. So you know what kind of returns you can expect from real estate. In the short term, it could be anything. In the long term, it beats inflation. That's about it. But equity, that is the only asset class which can beat inflation consistently over a long period of time because of this reason that, it's a very productive asset class. The asset that we are buying here, they grow in size. So next is, will the market correct when there are higher inflows in SIPs every month? So we have seen the SIP data. It is going up every year. Going up every year. So just to answer point blank, the data is going up every year. Markets are going up every year. So, and in between, there have been fantastic corrections. Like while Nifty 50 index may not have corrected during 2018 and 19, you look at small cap index and SIP data was fantastic even during that time also. You look at small cap index, you look at mid cap index in 2018 and 19. There were more than 50% of listed companies which were down by more than 50%. There was a time like that in 2018-19. Just imagine. And SIP data was continuing to go up. And Nifty 50 was also going up, by the way, during that time period. Only small cap and mid cap index were taking the beating. And the larger market, we leave aside top 100 companies. Even in those top 100, there were a few companies which had corrected a lot. But leave aside those 100 companies. You then look at everything else. Big correction in the market was happening at that point in time. So I think I tried to answer your SIP related question, but also I'm trying to make a point here is that sometimes index is telling you something, but what is happening underneath it is very different. So Nifty 50 index at that point in time was telling us that everything is absolutely fine, markets are going up. But that was not the case. There was bloodbath happening in the markets, and we have lived through that correction. Our clients, our portfolios have lived through that correction phase. And that was the time actually when the first row in our vintage returns slide was that first row, the client started at the peak of the market. They lived through that correction. And this is where another point now I'm trying to link from the presentation. For the long-term wealth creation journey, you have to be ready to tolerate short-term pain. These corrections that we show on one of the slides is not a one-time thing. These are given in the market. Drawdowns are bound to happen. We can't dodge it. We can't avoid it. And we can't time it either. So we need to be ready to go through that volatile time phase. But if we understand volatility, how we can take advantage of it, then we can turn everything around this whole concept and start looking at it as a way of making money rather than getting worried. Just increase your time horizon, leave some cash spare to deploy whenever needed. And there you are. That's the formula. Rohit, you have anything to add here?
No, not really. I think nothing really.
What is your disclosure? No. Please reach out to our team member and they will be happy to explain you in detail. Next question is, in general, for a
I think we've answered this question, Rajat.
Okay, that's totally. Yeah, right. All right. So with this, we come to the end of the presentation and the Q&A session as well. If there are any more questions, we are more than happy to take them. Yes, we have got one more. For the retirement scenarios, can we keep accumulating the money in Vridhi? So the longer the horizon, so I'm not sure when do you plan to retire from here for how many after how many years. So longer the time horizon in equities, the better it is. We always say, and Rohit also mentioned in one of the answers that if the time horizon is anything less than 3 years, one should not invest. If the answer is more than 3 years, 4 years, and the higher it is, better it is. We are telling one again and again. So yes, equities is the best way to approach it in our view. Yes, you can look at it if your horizon the money that you looking to enjoy in your retirement phase, if you're not going to withdraw it for 3 4 years, yes, then you can look at it. We have answered. There's one more question. We have already answered it, that we look to double our money in the 3 to 5 year time period. Uh, anything, even if it doubles in 5 years, we believe if we continue doing that for 20 years, that will be a fantastic outcome. We'll wait for another minute or so. If there are more questions coming in, we'll answer them. Yes, we have deployed. Another question is, have you deployed money during the COVID period? Yes, we did that. That was a time period which was very, very uncertain, very difficult to know what will happen to which company, which sector will behave, in what ways afterwards. But the moment we started getting some clarity out of it, and we realized some sectors are probably nothing is going to happen to them, and when we got that clarity, we started deploying money back into the markets, and probably that is the reason the kind of returns that you see today, because money deployed during that time really proved very, very advantageous, or has grown a lot since then. Is your fees capped as percentage of total AUM? So fixed fees is 1.5%. Then there is which is capped as percentage of AUM. And then there is profit share, which happens after 8% hurdle rate. And we have high watermark principle in place, and that high watermark principle compounds. We would request you to get in touch with our team to understand this in detail, and specifically stress on the point of high watermark and the way it compounds. What does that really mean? Because this is a very beautiful concept in profit sharing model, which we have adopted from learnings from best of the investors, and this basically uh, is in the favor of the clients, and that's why we would urge you to understand this in greater details. All right, I guess that's about it for today. We thank you everyone for giving us time, and giving us your valuable time and asking these questions. We really appreciate it. So many interesting questions, which and we hope that we have been able to answer all of them. And if there are still any left out questions, and or any follow up questions that you would like to ask us, you can get in touch with our team, and we'll be more than happy to answer all of your questions then. With that, we come to the closing of our today's session. Thank you so much. Have a good evening. Thank you so much, and rest of the weekend. Bye.